Welcome to Gold Cipher. If you have a savings account at a major well-known bank, your money is losing value every single month. Not because of anything you did wrong. Because your bank is paying you 0.01 to 0.46% while inflation erodes about 3% of your purchasing power every year. By the end of this video, you'll know exactly how much you're losing, why your bank does this, and what to do about it this week. Let me show you the actual numbers first. HYSA's standard savings account pays 0.01%. Wells Fargo currently pays 0.15%. The FDIC national average is 0.46%. These aren't estimates, these are the published rates right now. Meanwhile, inflation is running at approximately 3% annually. Here's the math that most people never do. If your bank pays you 0.46% and inflation takes 3%, your net real return is negative 2.85%. Your nominal balance goes up slightly, but your actual purchasing power is declining every single year. And here's the part that makes this completely avoidable. There are savings accounts, federally insured, available to anyone with an internet connection, easy to open in 10 minutes, that currently pay 4.5 to 5.5%. Same federal insurance. Same government protection. Completely different rate. The gap is not small. On $10,000, the difference is $454 per year. On $50,000, it's $2,270. On $100,000, it's $4,540 annually for doing nothing other than moving your money to the right type of account. Let me put dollar amounts on this so it's impossible to ignore. At $5,000 saved, the difference between big bank and high yield is $227 per year. At $10,000, it's $454. At $25,000, it's $1,135. At $50,000, $2,270. At $100,000, you're leaving $4,540 on the table every year by keeping money in the wrong type of account. I want you to pause and calculate your own number right now. Take your savings balance and multiply it by 0.0454. That's approximately how many extra dollars you would earn per year at a high-yield account versus the national big bank average. This is money that requires zero additional work, zero risk, and zero lifestyle change from you. The only thing that changes is which account holds your money. Here's why your bank pays you almost nothing, and it has nothing to do with interest rates or the economy. It's a deliberate business decision. Your bank takes your deposits and lends that money out as mortgages, car loans, and credit cards at 6 to 8% or higher. They profit on the difference between what they charge borrowers and what they pay you. The lower your savings rate, the higher their profit margin. That 0.01% isn't an accident. The second reason. Inertia. The average American has had the same bank account for 16 years. Banks spend billions on mobile apps and branches to keep you comfortable and not paying attention to your interest rate. They know most people won't switch. And the third reason, the one most people don't know. The FDIC deposit insurance on an online high-yield savings account is completely identical to the insurance on your big bank's account. The same $250,000 federal protection per depositor per institution. There is no safety advantage to leaving money in a big bank at a lower rate. That belief is a myth worth billions of dollars to the banking industry every single year. So, what is a high-yield savings account? Exactly what the name says, an FDIC-insured savings account that pays significantly more interest. The reason online banks can offer these rates is simple. No physical branches. No buildings to maintain, no tellers to pay, no ATM networks to run. Dramatically lower overhead means they pass the savings to you in the form of a higher interest rate. Here are the specifics. Competitive high-yield accounts are currently paying 4.5 to 5.5% APY. Most have no monthly fees. Many require zero minimum balance. They link to your existing checking account in minutes. You keep your current bank for daily spending and just move your savings somewhere that actually earns. Transfers take 1 to 3 business days. Important to be clear, I'm not recommending any specific bank in this video. This is educational content, not sponsored. Use bankrate.com or NerdWallet to compare current rates. Rates change frequently, and you should verify before opening anything. Look for FDIC insured, no monthly fees, and no minimum balance requirements. Those 3 things are your filter. Side by side, here's the comparison. Interest rate. Big bank, 0.01 to 0.46%. High yield savings, 4.5 to 5.5% APY. FDIC insurance. Identical, both protected up to $250,000 by the federal government. Monthly fees. Big banks sometimes charge $5 to $15 unless you maintain a minimum balance. Most high-yield accounts, none. Minimum balance. Big banks often require $300 to $1,500. Most high-yield accounts, 0. Physical branches. Big banks have them, high-yield accounts don't. Transfer speed. Same bank transfers are instant. High-yield transfers take 1 to 3 business days. The verdict. Same safety, far more money. The only real trade-off is that 1 to 3 day transfer window, which matters very little if you keep 1 to 2 months of expenses in your checking for daily access. Here's how to think about your money in buckets. Daily spending stays in your checking account. You need instant access. Emergency fund, which should be 3 to 6 months of expenses, belongs in a high-yield savings account. It needs to be accessible and should be earning 5% while it waits. Short-term goals in 6 to 18 months, a vacation, a car, a down payment you know is coming, go in a high-yield account or a short-term CD if you know the exact date. Money you won't need for 1 to 5 years can go into a CD ladder or rolling Treasury bills to lock in today's rates. And money you won't need for more than 5 years, invest it. Savings accounts and CDs lose to inflation over long horizons. That bucket belongs in a brokerage account, not a savings account. 5 savings mistakes most Americans are making. 1. Keeping savings in a checking account. Checking pays 0. Every dollar there is a missed opportunity. 2. Assuming online banks are risky. FDIC insurance is legally identical whether the bank has branches or not. 3. Saving long-term money instead of investing it. Money you won't need for 10 years doesn't belong in a savings account. It belongs in index funds. 4. Not comparing CD rates before locking in. The difference between the worst and best 1-year CD can exceed 1.5%. 10 minutes on Bankrate before committing is always worth it. 5. Ignoring rate changes after opening a high-yield account. High-yield rates move with the Federal Reserve. After a rate cut, check your rate quarterly. If something significantly better is available, switching takes 10 minutes. For steps for this week. Step 1. Check your current savings rate. Log into your bank, find your savings account, and look at the interest rate. If it's under 1%, you are leaving real money on the table. Know the exact number. Step 2. Open a high-yield savings account this week. Use Bankrate or NerdWallet to compare current rates. Look for FDIC insured, no fees, no minimum. The account takes 10 minutes to open. You don't close your existing bank, you keep it for daily transactions. Step 3. Transfer your emergency fund. Keep 1 to 2 months in checking for instant access. Move everything above that to start earning 5%. Step 4. Set a calendar reminder every 3 months to check your rate. High-yield rates change with the Federal. Stay aware. Switching if needed takes 10 minutes. Once your emergency fund is earning 5%, there's a next level for money with a known future date. Certificates of deposit lock your money for a fixed term, 3 months to 5 years, in exchange for a guaranteed fixed rate. Current 3-month CD rates are around 5.2%. 1-year CDs are around 5%. The trade-off. Early withdrawal penalties. Only use money you definitely won't need before maturity. Treasury bills are short-term U.S. government debt, the safest investment that exists. For week T-bills are yielding around 5.3%. You buy them at treasurydirect.gov in minimums of $100. An added benefit. T-bill interest is exempt from state income taxes, only federal. For money you won't need for 1 to 6 months and want absolute zero risk, T-bills currently beat most high-yield savings accounts. Screenshot this screen. Big bank average, 0.01 to 0.46%. High-yield average, 4.5 to 5.5% APY. Inflation, approximately 3%. Net real return in a big bank, negative 2.85%. FDIC protection, identical at both. Compare rates at Bankrate or NerdWallet or any other comparing platforms, not sponsored. For steps: check your rate, open a high-yield account, move your emergency fund, review quarterly. Open a high-yield savings account this week. It takes 10 minutes, it's free, and your money is exactly as safe as it was in your big bank. Staying where you are costs you hundreds of dollars every year, and that's just math. Subscribe to Gold Cipher for new financial intelligence every week.